Imagine a world where a ragtag group of retail investors takes on Wall Street, causing a seismic shift in the financial landscape. This is the story of GameStop and Roaring Kitty, a saga that transcended the boundaries of traditional investing and became a symbol of a new financial era. In early 2021, a Reddit community known as r/Wall Street Bets turned the financial world upside down. They spotted an opportunity in GameStop, a struggling video game retailer, and decided to take on the big players, the hedge funds betting against the company's success. Leading the charge was a YouTuber and financial analyst named Keith Gill, better known as Roaring Kitty. His passionate analysis and charismatic online presence inspired thousands to join the movement, driving GameStop's stock price to unprecedented heights. But this wasn't just about making money. It was about sticking it to the big guys, the hedge funds, that seemed untouchable. It was a David versus Goliath battle, and for a brief moment, David won. The timeline of events is nothing short of remarkable. In January 2021, GameStop's stock price was languishing around $17 per share. Roaring Kitty's detailed analysis and optimistic outlook on GameStop's future started gaining traction on Reddit. By mid-January, more and more retail investors jumped on board, buying up shares and options. The stock began to climb, hitting $40, then $100. The frenzy reached its peak on January 28, when GameStop's stock price skyrocketed to an astonishing $483 per share. Even ignoring the craziness of meme stocks, there are still going to be periods of rapid stock growth or contraction from time to time that might or might not correspond to macroeconomic trends. What is the right strategy? Or perhaps that question is too narrow because it implies there is a single correct strategy to pursue. More broadly, what are the characteristics of a winning strategy? Warren Buffett, whom we all know, would suggest investing in index funds. Is that a path to prosperity? Stay tuned as I dive into topics such as random walks, tulip mania, and the efficient market hypothesis. First though, a disclaimer. What follows should not be considered investment advice. Please consult an investment advisor before making any investment decisions. My personal favorite book on investing is called A Random Walk Down Wall Street by Burton Malkiel. There are numerous concepts described in that book, but a few themes are most prevalent. First is that neither fundamental analysis nor technical analysis will outperform the market. According to Investopedia, fundamental analysis measures a security's intrinsic value by examining related economic and financial factors. Fundamental analysts study anything that can affect the security's value, from macroeconomic factors such as the state of the economy and industry conditions, to microeconomic factors like the effectiveness of the company's management. The end goal is to determine a number that an investor can compare with a security's current price to see whether the security is undervalued or overvalued by other investors. This video mostly discusses investing in public equities, for which most people believe there's at least some level of intrinsic value. However, take a look at cryptocurrencies. Some people believe the cryptocurrencies don't even have any level of intrinsic value. How would you value those? The other camp includes the technical analysts. Investopedia describes technical analysis as a trading discipline employed to evaluate investments and identify trading opportunities by analyzing statistical trends gathered from trading activity, such as price movement and volume. Unlike fundamental analysis, which attempts to evaluate a security's value based on business results such as sales and earnings, technical analysis focuses on the study of price and volume. Malkiel's position on this is that these types of analyses do not outperform the market because the performance of the market follows a random distribution, in other words, a random walk. One type of trading that will not be covered in this video is quantitative trading. Quant trading involves complex mathematical models, also high-frequency trading in certain strategies. The end result being that the average retail investor just doesn't really have access to that type of trading, and for that reason, we've decided to exclude it. Regardless of whether Malkiel is correct in his view that neither fundamental nor technical analysis will outperform the market, I think it is safe to agree with his position that human psychology decreases investing performance. I would like to spend a bit more time here because any investor, be it a professional or retail investor, will battle these challenges, and it will also be relevant to a later segment of this video. One of the factors of human psychology that will negatively impact investing performance is overconfidence. I'm sure we have all invested in a stock or had a gut feeling about a stock and it turned out great. This might lead some of us to overestimate our abilities. A logical next step would be to double down on our gut instincts, perhaps performing less analysis and/or taking more risk. On the flip side, if we lose money on an investment, a common response might be to blame the loss on outside factors, instead of trying to uncover the ineffectiveness within our trading decisions. Another challenge is biased judgments. The concept here is that we might think that we have control over certain situations even though the outcome is perfectly random. Now, the outcomes of sporting events are not random, but many of us have superstitions when it comes to our favorite team. One of the hometown heroes here in Kansas City is Patrick Mahomes. At one point, his wife mentioned that he has worn the same pair of underwear for every NFL game in which he has played. As quarterback, Mahomes has some amount of control over the game. I realize he doesn't really think that changing his undergarments will have an impact on the outcome of the game, but it highlights the very human desire to think that some of our actions will help lead to a desired outcome, even though those actions have no actual bearing on the outcome. Stay tuned to the channel for an entire video dedicated to the topic of cognitive biases in decision-making. Third is herd mentality, which makes it hard to stand on the sidelines when an individual stock or the market as a whole is doing well. Herd mentality is a big factor in the incidence of asset bubbles and market meltdowns that follow. What is an asset bubble, though? The first widely accepted asset bubble was the Dutch tulip mania that occurred from 1634 to 1637. Nothing too complex here. Tulip bulbs became a hot commodity and prices skyrocketed. Some records indicate that folks were willing to pay 10 times the annual income of a skilled worker for one bulb. The bubble eventually burst, and even though it is not believed to have caused widespread economic distress, it is still noteworthy. More recent examples include the dot-com bubble of the late 90s and, some would argue, meme stocks such as GameStop or cryptocurrencies. It might seem as though herd mentality is another form of peer pressure where you might know you don't want to do something, but go along with it because everyone else is. What is interesting, though, is that Malkiel shares certain studies that suggest our perceptions actually change. For example, a study was performed in which two lines were drawn, A and B. Line A is clearly longer than line B. There are a number of people who are portrayed as participants but are instead actors. They all say that line B is longer. The final person to offer an opinion is the only real study participant. In many studies, this person also says that line B is longer. In post-study interviews, the participant reiterates that he or she really thought that line B was longer. Fascinating. The fourth component of how human psychology affects our investment decisions is loss aversion. Let's play a game to understand this concept. I will flip a coin. Heads, you win $100. Tails, you lose $100. Would you play this game? Most people would say no. In fact, some studies have shown that the payout must grow to $250, with the potential loss still being $100, before people are willing to play. The expected payout is very positive, which indicates risk aversion, not risk neutrality. What is unclear to me, though, is how many times you are allowed to play the game. If you are, in fact, only allowed to play once, then absolutely put me in the loss-averse crowd because I don't want to lose $100 after one coin flip. But if I could play many, many rounds, then I'm going to let the expected outcomes rule in my favor, and I would accept a much lower payout. If I could play 10, 20, 50 times, I'm going to come out ahead. Moving past the different types of analyses as well as human psychology, there is a term called the efficient market hypothesis that needs to be discussed. Proponents of this theory believe that a stock's price is reflective of all available information, and therefore, it is impossible to sell a stock for an inflated price or buy one that is undervalued. Let's just say I'm not a firm believer in that form of the efficient market theory, which is called the strong form. Here is a common anecdote used to discredit it. If you are walking down the street and see a $100 bill, then that bill must be fake if the strong form of the efficient market hypothesis is true. Why? If the bill were real, everyone would know about it at precisely the same time and it would have been picked up already, or at least there would be others ready to pounce. I don't buy it. Malkiel's final proposition is that investors can beat the market by investing in index funds, bonds, real estate, and cash, the percentages of which depend on the investor's investment horizon and will change as the investment horizon becomes shorter. The reason that the asset allocation formula changes over time is because the volatility of the stock market is quite high for 1 year, but is much lower as the hold period lengthens. So it isn't just asset allocation that matters, investment horizon is critical too. This is great though. Everyday investors can beat the market with this strategy. What do we mean by that though? Instead of a market return of let's say 10 to 12%, we earn a return of 12 to 14%? Does that drastically change anything? Well, what does the math say? $1,000 invested today for 30 years, averaging 8% per year, would grow to $10,063. If all other parameters remain the same, but the average return were 10%, the sum would almost double, totaling almost $17,500. That is meaningful, right? My argument would be that no, it does not meaningfully change anything. Am I really trying to say that an additional $7 for every $1 invested is not meaningful to me? No, that's not what I'm saying. What I'm saying really is that I'm asking and answering the question in a different context. Does beating the market allow me to fundamentally change how I approach my career, my life in general? That is the precise question to which I would answer no. An incremental 200 or 300 basis points per year would not allow me to change my job, allow me to feel greater financial security, or freely pursue my interests. I might be able to retire a year or two earlier, or live more comfortably in retirement, but that's it. In order to feel a change to my normal way of life, an outsized return is required. That leads me to reasons why I don't like stock market investing in general. The first reason is that in order to earn outsized returns, a diversified strategy will not work. Stock picking is required. I don't remember a lot of quotes from my college professors, but I remember at least one. An investments professor said that if you want to get rich in the stock market, invest in one stock. He followed that up by saying, if you want to lose all your money in the stock market, invest in one stock. So the strategy used to maximize your returns is the same strategy that could potentially lead to a total loss? I don't know about me, but are there any takers out there? Another reason I do not like stock market investing is because of the randomness that Malkiel describes in his book. Generally speaking, mutual fund managers attempt to outperform an index, typically the S&P 500. Historically, the return has been in the 10 to 11% range, depending on which time period is used. However, the majority of funds do not outperform the benchmark. According to David Granahan for Go Banking Rates, roughly 79% of mutual funds underperformed the S&P 500 in 2021, a figure that has grown 86% in the past 10 years. Returns can also vary drastically as funds target many different assets, sectors, and companies of different sizes, as is the case with stock market mutual funds. For example, the energy sector has performed extremely well in 2022. A mutual fund heavily weighted toward energy is likely to be outperforming other funds with no energy exposure. An experiment in Malkiel's book proves this point. He had blindfolded monkeys, literally, throwing darts at a dartboard to pick stocks. These random choices actually fare better than professional money managers. How can that be true unless the market does follow a random walk? In a recent article, the Wall Street Journal replicated the experiment and their returns using random stock picking were around 80%, and professional money managers only earned 24%. The one shortcoming in these experiments is that they were only run for 1 year, and thus we were unable to evaluate volatility. After all, the goal is a higher risk-adjusted return. Because of a lack of volatility data, I set up my own experiment. These were the steps. Step 1. Obtain historical stock market performance for the individual components of the S&P 500. Step 2. Set up 2 different stock picking methods. Method 1. Pick 10 stocks at random and hold those same stocks over the analysis period. Method 2. Pick new stocks each year in the analysis period. Step 3. Calculate the annual return for the portfolios in both methods, assuming equal investment dollars per stock, not an equal number of shares. Step 4. Calculate the standard deviation of returns of the entire portfolio to measure volatility. Step 5. Compare the risk-adjusted returns for each method to the return of the S&P 500. The method we used to calculate risk-adjusted return was what is called the Sharpe ratio. The Sharpe ratio is calculated by subtracting the risk-free rate from the observed rate of return and dividing that result by the standard deviation. A few notes to the process. Due to data constraints, we could not draw from the entire S&P 500. Instead, we only used the first 250 companies alphabetically. Additionally, our investment period was 2015 to 2023, again due to data constraints. The results were, to a data nerd like myself, quite fascinating. In the trials I ran, random stock picking rarely underperformed the index and in many cases outperformed it. Now, these results might not correlate with future returns, but it is further evidence supporting the difficulty in predicting or forecasting future stock performance. Even if you want to ignore randomness and the risk of asset bubbles, perception has too great of an impact on the price of stocks, in my opinion. Here's an example. On May 30th, 2024, Salesforce, with the ticker CRM, reported earnings growth, which is good news. However, the stock price dropped a significant 19.7% the following day. There are a couple of reasons for this. 1. Missed revenue target. While earnings per share grew, Salesforce fell short of analyst expectations on revenue, which is a key metric for growth. 2. Weak guidance. The company's guidance for the next quarter was lower than anticipated, suggesting a potential slowdown. This combination of factors caused investors to lose confidence in Salesforce's future prospects, leading to the stock price decline despite the earnings growth. I completely understand the mechanics here. A stock's price is dependent upon future growth prospects. If future growth prospects are reduced, then sure, the stock's price should come down. But 19.7% after the company reported earnings growth? I don't know. It just seems that a 20% reduction in value is too large of a swing given the results that Salesforce reported. If the stock market wasn't the path I took to riches, or at least the pursuit thereof, how did I get where I am today? Please remember that what follows should not be considered investment advice. Please consult an investment advisor before making any investment decisions. My career goals were centered around having the proverbial seat at the table and earning enough to achieve financial freedom. Investing in public equities wasn't going to work for me as discussed above. The next big idea was to rise through the ranks of a large company. Problem here is that there is a huge discrepancy between senior management pay and worker pay. For example, when I worked at a publicly traded company, I made in the ballpark of $100,000 per year. My direct supervisor was a senior VP and reported directly to the CEO. So I was 2 levels down from the CEO. Even being only 2 levels down from the CEO, the pay discrepancy was huge. If my memory serves me correctly, the CEO made around $2.3 million, and my boss made around $800,000. The pay ratios were about 23-to-1 and 8-to-1 respectively. Working for a large company would only work if I was able to reach the very highest echelon within the company. End result? Increased risk. Additionally, perhaps I am in the minority here, but I have a general distrust for large companies. One reason for this is that managers expect a level of loyalty and commitment from the employees that the organization is unwilling to reciprocate. End result? Increased risk. Finally, and most importantly for me, I just wasn't cut out for large company life for a multitude of reasons. I didn't think of myself this way at the time, but I'm an entrepreneur at heart, and that doesn't mix with large company bureaucracy and the slow pace of change. End result? Increased risk. Investing in large companies and working for large companies were both out. Through all of this, I felt like I was missing something. From time to time, I would think back to certain experiences from college and even some classes. One class that kept coming to mind was an engineering finance class that taught students how to analyze the financial impacts of purchasing a new piece of equipment. We would assume a certain cost for the equipment, incremental revenues and expenses, and then discount the cash flows to calculate a net present value. If the net present value was positive, it indicated returns were greater than our cost of capital and that the project should be pursued. Incremental cash flow wasn't guaranteed, but if I were the decision maker at the company, and if all else failed, I could pound the pavement to drum up sales and help affect the result. Here was a scenario in which I could invest in a physical, income-producing asset, and if performance wasn't what was expected, I could take matters into my own hand to improve the situation. And that's when the light went off. So much of what I didn't like about investing in public equities or working for a large company was the absence of control. Public equities, if you believe Malkiel, exhibit a random walk. Working for a large company isn't a random walk, but you certainly do not have much control over your career, even if your supervisors try to tell you that you do. The conclusion for me? Ditch public company investing, forgo a corporate career, and instead pursue small company ownership. I liquidated my 401k, as did my business partner, and we set out to buy two businesses, one for me to run and one for him to run. We launched 4 Pillars in 2015, bought our first business in 2016, which I ran, and our second in 2017, which my partner is still running to this day. Though our strategies have changed a bit over time, with the exception of creating a diversified portfolio, much of our strategy is in direct opposition to investing in public equities. First on our list of priorities is avoiding asset bubbles. We do this by maintaining pricing discipline. When I say pricing discipline, what I mean is that we have a standard view on valuation and structure. We typically value companies somewhere between 4 and 6 times EBITDA and require that the sellers have some sort of ongoing financial interest in the company post-close, usually through rollover equity or seller financing or some combination of the two. Even though we sometimes would like to chase companies and pay higher multiples, we resist that urge unless there is a very compelling reason to do so. Proportional to our dislike for asset bubbles is our desire to find undervalued assets. Now, this is not trying to buy a business for less than market value. Instead, it relates to the market of transactions as a whole. It is commonly accepted that larger companies trade for larger multiples. One such dividing line is $5 million of EBITDA. If we buy a business with EBITDA of less than $5 million and grow it to greater $5 million, then the multiple we sell it for will likely be higher. Secondly, we disproportionately allocate excess cash to the most attractive projects and/or companies. This would be in contrast to index investing, since every dollar of investment is invested pro rata to the companies in the index. Third, we invest where we think we can add value by being active in the business. We are not passive investors that attend the quarterly board meetings and try to manage the business from the proverbial ivory tower. For 4 Pillars, being active starts with getting to know the people. Given the size of some of our portfolio companies and the geographic distance from Kansas City, I will never know the names of every employee. But developing relationships with the key managers is vital. Though relationship building is ongoing, another required activity in our minds is developing a strategic plan. I've done an entire video on what strategic planning is and how 4 Pillars executes the strategic planning process. In short though, the company needs to have goals, and the people of the company need to be aligned on the objectives required to achieve those goals. Those goals often center on growth, which could be organic, M&A, or a combination of the two. This analysis will often start with the growth potential for the industry as a whole, and then the focus will narrow to the individual company. The strategic planning process isn't the first time we analyze growth potential though. That process first takes place during our diligence process prior to buying the business. During our diligence process, we also look for what we call life cycle growth potential. Life cycle growth potential is the term we use to describe a company that has the potential to grow but is being held back by current ownership. That sounds bad, or at least somewhat critical, but it is not meant that way. In many family or founder-owned businesses, growth is no longer a priority for the owner. This might be due to age/retirement related issues, asset diversification goals, or perhaps lifestyle priorities. Age and retirement issues are fairly easy to understand. Asset diversification relates to the likelihood that the business owner's largest asset, by far, is probably the business. Investing further in the business would further decrease diversification, which is even riskier with shorter investment horizons. Lifestyle priorities might be around grandkids, golf, or other hobbies, or standard of living. Talking more about standard of living, the companies we target have at least a few million in earnings and probably have had that level of earnings for several years. Does growing the business from, let's say, 3 million of EBITDA to 4 million really improve the quality of the life for the owner or his family? In many circumstances, I have been told the answer to that is no, and I would agree with that. The final type of growth potential we look for relates to sophistication. Our experience has been that companies with revenues in the $20 million to $100 million range have started down a path of increasing sophistication in the business, but might have room to grow or improve. My background is industrial engineering, which has ingrained in me a process orientation. I often evaluate a target based on the extent to which the company is driven by defined and optimized processes and procedures, and the potential benefits if the company improved in this area. We went through this exact process in our diligence on our first portfolio company, Southwest Steel. First, we analyzed the industry, including local competitive dynamics. We felt there was organic growth potential here, but were more excited about the growth potential via M&A. Life cycle growth potential was more exciting than organic growth potential, though. The former owners had decided against purchasing a certain type of equipment because it was too costly. We performed our own analysis and felt that we could make it work with used equipment. Fortunately, we were proven correct. Finally, we evaluated the level of processes and procedures. On the one hand, we had a plant manager that resisted implementing lean manufacturing techniques. On the other, we had a CFO that prepared monthly financial statements on ledger paper. Were those correct or incorrect positions? That is not really the question I would ask. Instead, the question I would ask is whether those conditions suggested that the company could improve via the implementation of processes and procedures. After almost 10 years of operating under our own banner, we have closed 7 deals with 6 companies in our portfolio at present. By the end of 2024, those numbers will be 10 deals closed and 8 to 9 companies in our portfolio. We are by no means perfect. At times, we haven't even followed our own processes. But I can tell you this, when we have gotten into trouble, it was a whole lot better knowing that we would be the ones that had to dig ourselves out of the hole as opposed to waiting for someone to help us. Thanks for watching. I know you will now agree that my reputation as the most boring guy in private equity should be as equally accepted as the value in index investing.